Powell and the Fed met in Jackson Hole, Wyoming last month at a posh resort and declared mission accomplished with regard to inflation. As I look at that situation, I'm a little bit concerned that there still may be a little bit more work to do. And so, what I thought I'd do today is take a look at a few of the things that could go wrong in our continued fight against inflation. So, going back over the last few years, what we've seen is inflation at elevated levels compared to where it really had been since before the financial crisis. It peaked in June of 2022 at around 9%, the highest it had been since the 80s. So, when we're thinking, just a little bit more than 2 years later that we've beaten inflation, that we're back to normal, I have some questions about that and some concerns that we may not be able to maintain this 3% target that we've had for so long. A couple of the things that concern me specifically are government spending as a percentage of GDP compared to where it's been historically. If we look at the last several years, the government has been spending at levels about 6% in excess of our GDP. What that's done is it's added almost double the amount to the national debt as a percentage of GDP in the last decade. We were sitting in the 65 to 70% range in 2008 and 9. Today, we're about 120%. Depending on your estimate, $25 trillion of debt so far. So with government spending at elevated levels as a percentage of GDP, my primary concern is what happens if we enter an economic downturn and the government feels like they need to stimulate the economy again. We are already spending in excess of what the government's bringing in, and there's the possibility that if markets go down, we get employment above 5-6%. Right now we're about 4.5%, which is elevated from where it was just a couple of years ago. What's going to happen in that environment? Will big bond holders of U.S. Treasuries get concerned, feel like the dollar could be weakening? Those are all things that give me a little bit of pause when we look at the historical move from trying to keep the deficit at 1 to 2% of GDP on an annual basis to now being okay with running deficits in excess of 5-6% every year that have led us to owe more than the GDP of the United States. So to summarize, my biggest concern with regard to government spending is not necessarily that we have a large deficit. That's been the case for many, many years, really going back to World War II. My biggest concern is if something goes wrong in the economy, where can we go from here? Do we go back to the COVID levels of 10, 12% deficit spending on an annual basis? And if that happens, are some of our partners in the developed world, Europe, Japan, are they going to get a little bit weary of owning US debt? The other thing that concerns me just a little bit about the fight against inflation is the ongoing environment of tariffs and reshoring or friendshoring. To give a little bit of detail on that, tariffs really are a tax that a government imposes on other countries for importing goods into an economy. So the biggest example that we all talk about a lot is China sending goods, exporting goods to the US, and we charge a tariff for those goods coming in. Ideally, this is considered a protection against US workers so that China can't undersell us on every single good, driving US manufacturers out of business. One of the interesting things about the political environment that we're in right now is I think the perception that Donald Trump is the president of tariffs, and whether it's Joe Biden or Kamala Harris, a free trade type of philosophy. What we saw was that Trump put into place significant tariffs on China, and especially, but over the last few years, the Biden administration has continued those tariffs, and some are expected to expand in the next few years. Between 2024 and 2026, we have increases to tariffs expected on things like steel, aluminum, semiconductors, electric vehicles, cranes, solar cells. So that leads me to think that this higher tariff environment is probably here to stay. What we also saw after COVID and the supply chain disruptions that it brought about was significant spending on infrastructure in the US and some of our closest allies. So things that were built in, say, China at very, very low cost now are being produced in the US, in Mexico, in Canada, which in some ways is very good, but the issue is we just can't do it as cheap as they can. And so some of those costs, whether it be the government that's paying it or consumers that are paying it, are going to flow downhill and be paid by either individuals in the US or our government. So that leads to the question, if we're concerned that inflation may not be transitory and that it could come back, maybe with a vengeance, pushing up beyond 5% again, what are some things that investors can do in the interim period? For one, I would say that it has become very popular over the last few months as the yield curve has become uninverted on the 2 and 10 year for the first time in several years to extend duration of fixed income or bond maturities. I would argue that we're probably early to the idea of extending bond duration. If we think about where the indexes are right now, the Barclays Ag typically sits 6 to 7 years of duration. My feeling is that if inflation could be resurgent, that's a little bit too long. And so keeping duration short probably makes some sense. I would also lean towards high credit quality in fixed income. Credit spreads, which are the difference in what one earns for, say, a AAA government bond and a BB corporate bond or a sub-investment grade bond, are historically tight. That would lead one to lean towards quality and shorter durations for their fixed income portfolio in anticipation of increased inflation. Another thing in anticipation of inflation that I think most investors should do is maintain equity exposure. If we think about what has kept up with and beaten inflation over a long time, it's maintaining exposure to companies that are growing earnings and doing better than the rate of inflation. So whether that's US large caps, which have done very well over the last couple of years, smaller US companies, or maybe some international exposure, keeping some equity exposure, not panicking and getting too conservative is probably another way to fight inflation. Finally, for the last 10 to 15 years, we've been in a period of historic dollar strength where we've seen us reach parity with the euro briefly, get close to parity with the pound after the Brexit crisis in 2015-16 timeframe. I think that if we enter a period where the dollar begins to weaken, whether that be because of renewed inflation or because US interest rates are declining a little bit, it's important to maintain some exposure to economies outside of the United States. This provides a little bit of protection against some of those protectionist tariffs that could slow our economy down. And it also gives you exposure to companies that frankly just look more attractive from a valuation standpoint. So there's a lot of things to be concerned about with regard to inflation. I don't think necessarily, like Jerome Powell, that the game is won and that we can pop the champagne to congratulate ourselves on beating inflation. But if it does come back, it's important to be prepared by having a diversified portfolio, having an ongoing relationship with your financial advisor to talk about the potential things that you can do to improve the situation.